Good morning. I want to welcome everyone participating in this morning's webinar, Unraveling the Complexity of Expatriate Taxation. My name is Jennifer Disharoon, and I am the Director of Marketing at Gelman, Rosenberg Freedman. Before we get started, I would like to extend a special welcome to the members of Humentum joining us today. We also want to thank Humentum for hosting the webinar with us this morning. GRF has had a strong relationship with Humentum that goes back many years, reflecting our commitment to working with international NGOs over 3 decades. I'd like to start off today with some quick housekeeping items and explain what participants need to do to earn CPE credit for today's webinar. For the best sound quality, we highly recommend you connect by phone instead of your computer. If you have any technical questions or issues during the webinar, please use the Q&A function to speak with our webinar administrator for assistance. Technical assistance is also available from WebEx at the number shown here. Please note this webinar will be recorded and made available on our website following the event. The slides will also be posted at this address. Webinar participants seeking CPE credit for this presentation must submit a short evaluation survey that will appear automatically immediately following the webinar. Please write down the CPE words when they are given. They will not be provided again. You will be asked to recall these words in order to receive credit. If you have an active pop-up blocker, please take a moment now to disable it so it will not block the survey. Any technical questions about the survey may be addressed to Dominic Acosta at the address shown here. As the title of the webinar implies, today's learning objective is to provide attendees with a better understanding of expatriate taxation. 1 CPE credit is available to attendees of today's webinar. And at this time, I'd like to introduce our presenters. Troy Turner is a partner at Gelman, Rosenberg Freedman, providing tax advisory and compliance services to businesses and individuals who have international aspects to their tax situations, particularly expatriate taxation issues. Mr. Turner is a regular speaker on international and domestic tax topics for GRF's monthly webinar series, as well as outside groups. Kate Fiskin is a principal in Gelman, Rosenberg Freedman's outsourced accounting and advisory services group. She specializes in providing tax services for those living abroad and assisting many NGOs and for-profit organizations with expat and impact tax issues, host country taxation, and the development of their international tax policies and procedures. And here we have today's agenda. And with that, I'd like to turn this over to Kate.
Good morning, everyone. I will be covering 3 topics over the next hour. The first is the organizational expat strategy. The second one later on, after Troy does his presentation, I will be then speaking about expat overseas allowances, and then finally, host country taxation. So let's get started. Organizational expat strategy. Why are we talking about this? Well, the biggest reason is we want to limit any surprises your organization may find itself in. You ought to be concerned about developing and focusing on strategies, policies, and reporting systems to address compliance, IRS, host country taxation, reporting to funding sources, and to keep your employees satisfied and productive while they're working overseas. You need to ask yourself a question. How do we get the team together, and who makes up this team? Who has the lead? I think you want to make sure you have all the stakeholders involved on the team: finance, accounting, payroll, program, and executive level representation. What documentation information does your organization provide before and during and after the assignment? Do you have a checklist for documents that you want to make sure you have available on your inner website, payroll information, and other resources? How will you address compliance issues with the United States Internal Revenue Service and your state taxation organizations, as well as host country taxation? How will you do this proactively? New this year, we want to talk about the Trump tax cuts and the impact that's going to have on your organization, particularly as it relates to the moving and relocation costs. Be sure to know the types of individuals who are going to be your overseas employees: U.S. expats, green card holders, third country nationals, dual citizens. And how do you keep track of all their locations assignments? And how do you make sure you know the length of their assignments? Finally, you should be able to know the presence you have in each country, the visa process, and the host country taxation issues that may appear down the road. What I suggest is in the very beginning, before you even go into a country, make a list of who's going to be there, what you're going to be doing there. You might want to contact other NGOs working in that country, get their advice on how they went through the visa process and the housing. Use as many capabilities as you can before you go in that country to get yourself registered to do business in that country. Thank you.
Thank you, Kate. We're now going to talk about expatriate taxation. I think it's important for an individual that's going overseas and the organization that's sending them to have a general understanding of the tax implications on that individual before they send them overseas on a long-term assignment. So first and foremost, the thing that everyone needs to understand is that U.S. citizens and green card holders are taxed on their worldwide income on a U.S. return, no matter where they live and work. So first, we need to eliminate any confusion there. Just because a U.S. person or a green card holder gets sent overseas, that does not eliminate their federal requirement to file a U.S. return and report their worldwide income. So an issue that this causes when a person is stationed in a country that has local taxation and subjects that individual to local taxation, there is a concern that when you have this dual reporting, that a person could end up with double taxation, which is the worst result in the tax world, to be taxed twice on the same piece of income. And that's the primary concern that we want to avoid when we send someone overseas. We don't want to have them being double taxed. Now, there are three main remedies to avoid double taxation or to reduce a person's tax liability, assuming that maybe they're in a country that is not going to tax them. It's still important to understand what's out there for them to potentially reduce their tax cost. So those potential remedies, the first one is the foreign earned income and housing exclusion. So this is something that a person can qualify for when they're out on a long-term assignment, which can eliminate the taxation on earned income, so their salary from the organization. Another way they can eliminate double taxation is by use of the foreign tax credit. Built into the tax law is a foreign tax credit that's allowed at the federal level for income taxes paid to a foreign country. That's also on income that's being reported on the U.S. return to eliminate the double tax. And in this case, when this comes into play, you end up paying whatever country has the higher tax. it usually ends up with the result, but not double tax. And then lastly, you could potentially use a tax treaty, and generally those apply to more short-term assignments than do long-term as far as eliminating host country taxation. But then there also could be an international agreement in place that could eliminate local taxation on that individual's pay. So that should be looked into. So the topic we want to cover in more detail, and this is the most common benefit that an expat would look to get on their U.S. return to either lower their tax or to avoid the double taxation, is the foreign earned income exclusion. So it's important to understand how one qualifies for that, both at the individual level and the organizational level. So to qualify for the exclusion, one must move their tax home overseas, and then after they've done that, they must meet either the physical presence or the bona fide residence test. Now, the bona fide residence test is geared more towards people who are overseas indefinitely or permanently, or for really long-term assignments, say more than 3 years. They could make a claim under that test. So we're going to focus more on the physical presence test because I find that most people who are sent overseas to work are generally sent overseas between 1 and 3 years. And I believe the IRS would generally look for a person who's moving overseas for work purposes for a finite period of time to utilize the physical presence test. So first, to touch on the tax home again, in order to move a tax home overseas, the overseas assignment must be for more than 1 year, so a year and a day. So that's important to keep in mind when you're setting the time limits for an overseas assignment. So assuming that the person's going to be overseas for more than a year, then we want to make sure they qualify under the physical presence test. Now, the physical presence test is a mechanical test that one passes if they are overseas and present in a foreign country for 330 full days out of a 365-day period. So in a calendar year, you're, just if for someone who's overseas for the full calendar year, then you're just looking for during that time frame, making sure that they're overseas in their posted country, or they could be on vacation in a neighboring country. It doesn't matter the purpose for their presence in the foreign country in that case, but they just need to be overseas and in that present for the full 330 days. And if they do that, then they qualify for the full exclusion. Now, for the years where they go overseas and the years that they come back, they can qualify for a partial exclusion under the physical presence test. And to get the partial exclusion, you would look at the fiscal year from the date that they left the country to the anniversary of that date. So you look at that 365-day period, and you would want to make sure that that person was in a foreign country for at least 330 full days during that fiscal time frame. So, for example, if they left on July 1, you'd look at the period from July 1, say, of 2018 through June 30th of 2019, and make sure that they were present in the foreign country for a full 330 days during that time frame. And if they were, then they could qualify for a partial exclusion. And in this case, they would get half of the regular exclusion amounts because they met the test based on being overseas for 6 months of that calendar year that they're being taxed on. So now we're going to look at the amounts. Unfortunately, the foreign earned income exclusion is not unlimited. There are limits to it. So for 2018, the limit is $104,100. And the housing exclusion, a person can also qualify for that. And that's a little different. You must first have qualified foreign housing expenses that exceed a base amount, a floor amount. And for 2018, that amount is $16,656. And then the housing exclusion isn't unlimited, so the IRS has established a cap on the qualified expenses, and the standard cap for 2018 is $31,230. So if someone's in a standard cost location and they spend at least $31,230 in qualified foreign housing costs, which is generally rent, utilities, maintenance, insurance, things like that, security, that they could get an additional $14,574 exclusion on top of the 104, assuming that their total compensation package, is at least that amount. You can only exclude, the income that you actually are reporting that's earned overseas. Now, the IRS understands that not all locations have the same cost structure, and there are high-cost cities, so that there is a listing provided where the standard cap is raised depending on the location that your person is located in. So it's important to know that. The highest cost location currently, as of 2017, was Hong Kong, and the cap on the expenses for purposes of exclusion is $114,300, which I can't even imagine spending that kind of money on housing, but it must be possible. So again, keep in mind that in years where you're sending the person overseas and the year they come back, they can get a prorated exclusion based on the amount of time they're overseas during that year, and the amounts we just discussed would be prorated based on how much of the year that they are actually overseas. So some forms and resources that you should know about. At the HR level, you need to know about Form 673, and this is the payroll form that an expat would provide to the organization to certify that they plan to qualify for the foreign earned income exclusion and housing exclusion, and what that amount would be. And once you have this in hand, you're not required to withhold income tax on the excluded income. So if a person happens to have a total compensation package of, say, $104,000, and they're going to be overseas all year, and they're moving over on January 1, and they hand you the 673, then you don't have to withhold federal income tax on any of their compensation that year, because all of it will be excluded on their return from income tax based on the fact they've given you that 673. Now, the individual actually claims the exclusion on their return and shows that they qualify by filing Form 2555. So your employees will need to be aware of that. And then IRS Publication 54 is the publication that explains all these rules. So maybe your employees would be interested in reviewing them on their own, so they can see how they qualify and get more details. So that's a very useful publication to hand out to your employees before they begin their assignment.
Okay. Thanks, Troy. We've now come to our first polling question. Does your organization provide for professional tax advice or tax filing assistance for your expat employees? This could include initial consultation, annual allowance, reimbursement for actual costs, direct payment to a tax professional. Please take a moment now to record your answers. And while our participants are taking the poll, I want to give the first CPE word. So please write these down. We will not give these again. The first CPE word is taxation. If you want to receive CPE credit, please remember to add these words in the in the survey at the end. If for some reason you forget to update your pop-up or disable your pop-up blocker, you can always email those words to us, and we will make sure you get a CPE certificate for credit. Again, that first CPE word is taxation, and I'll spell it TAXATION. Okay, how are we doing on our polling question?
Thank you, Jennifer. We got the results, and we didn't have a high level of participation, so I don't think they're going to be that meaningful. But we did have a few people that do provide support, and we have a handful that don't. But most of you didn't reply to that, so you must be thinking about doing it, and we hope you are. So the next topic we're going to cover is state taxation. And now that we've covered the federal side, it's important to understand how being an expat affects the person's state filing requirements and withholding requirements. So often I'll get a question from a person who moves overseas. I think the assumption is that, once you explain the federal side and the foreign earned income exclusion, they're okay with that, but then they think that because they're not physically present in their state, that they don't have to file there anymore. And unfortunately, that's not the case. So, and that's because of this concept of domicile. So a domicile is a person's permanent home. It's one where a person intends to return when they leave for any sort of a temporary absence. And in this case, a short-term or long-term even assignment overseas, the last couple of years would fall into that temporary absence from a state law perspective. So it would mean that most of your employees will maintain their current state of domicile when they're posted overseas. And so knowing that they're still linked to their state, the state that they were living in when they moved overseas, we now need to understand, well, what does it mean to be a domiciliary resident of a particular state? So states have different ways to tax their domiciliary residents. And the first one is that they still consider them to be a tax resident as if they never left. So they still have worldwide income reporting. But the state has what we call federal conformity. So basically, the state allows the same foreign earned income and housing exclusion that the federal return has. So if the person in our previous example who had $104,000 in total compensation and gave you the $673, so they eliminate the federal income tax, the state would generally honor that too, and then they're a federal conforming state. They get the same exclusion on their state return, and they wouldn't have any state withholding or state taxation as well on that income. But if they had other income, then they're still filing as a resident and reporting that. So the next way a state could handle this would be worldwide income taxation. So they would still file as a resident, even though they're not there, report all of their income, and the state would be non-conforming. So they would not allow the foreign earned income exclusion. So this is obviously a bad result, but it's good to be aware of it up front. In this case, they'd still have the same withholding on their pay as if they never left. And there are a handful of states like that. A few that come to mind are California, Massachusetts. And another way that a state can handle, taxation of their domiciliary residents is to treat them as a non-resident for tax purposes. So this is obviously a good result. So the general premise here is that if the person is on a long-term overseas assignment and they're going to have minimal presence in their home state, that the state will only tax them on state-sourced income. So their foreign earnings won't be taxed, but if they have any other income, say they own a home and they decide to rent it while they're gone, then that rental income would still be reportable and taxed, their investment income, so on and so forth. But their foreign income or other income earned or sourced outside the state would not be taxed there. So you have non-resident taxation in those circumstances. New York has a provision for that. California does. West Virginia, and then there's others that have a non-resident provision for their domiciliary residents. And then, of course, there are some states out there that have no income tax, such as Florida, Texas, Washington, and there's others. And because of this gets into our next issue, which is the idea of a person wanting to change their domicile to another state or potentially to the foreign country while they're overseas. And this is a little tricky because it's not easy to change one's domicile from one location to another. In a U.S. context, when you go from one state to the next, normally for work, it's on more of a permanent basis, not temporary. And, you stop filing in one state and you start in the other. But generally, when you move overseas for a finite period of time, the state would still consider you linked to them as a domiciliary resident, and it would be hard to effectuate a change of domicile to a foreign country because most states require that you cut all ties with your current state and establish permanent ties or more indefinite ties with your new location. So if that's a foreign country, then you would have to do it there, and that's usually hard to do, with visa status and other things. So just don't see it happen that often. Now, sometimes you might see a person with a foreign domicile if they were living overseas when you hired them and they've been over there, since they were a child and they had to be U.S. citizens, so that's a possibility. But generally, if they're living in the U.S. and they go overseas, they're not going to normally be able to change their domicile to the foreign country. So this creates this whole state issue creates some HR issues because I know that all payroll companies want to know the person's state of record for payroll reporting purposes. And, of course, we want to know what state we need to withhold income tax in for that person while they're overseas. So we need to review what the rules are. Are they a conforming state? Are they a non-conforming state? Do they have the non-residency provision that we had? And then getting documentation to show, especially if they're going to be in a state or they're in a state that has that non-residency provision, how you document that they would meet that test, and therefore you don't have to do the withholding. And, of course, you're going to have employees that are going to want to say that they, moving from D.C., they were living in D.C., you sent them overseas, now they want to claim Florida or Texas or one of these non-resident or non-tax states. And, how do you deal with that, from an HR perspective? So a person's state of residency for tax reporting is their own tax position. But, if they're going to claim to have a state of record or a state of residence that's not the one you know them to be in or have been in, then you should get something from them for the file that shows they've done something to have some link to this other state, whether it's a copy of a driver's license with the Florida address or a utility bill or something in writing that says that they no longer are linked to the state you knew them to be in before they left the country. And one other note is I've seen some organizations kind of default to withholding income tax in the state where their headquarters are, even though the person had never lived there, or maybe they were posted there for a couple of months. They came from another state and they came to headquarters for 2 months, and then they were posted overseas for 3 years. And they, for some reason, the state where the headquarters are gets picked up as the withholding state, and then withholding just starts and goes from there. Just kind of be aware of that don't just default to the state where the headquarters are. So now we're going to shift back to Kate, and she's going to discuss the taxation of overseas allowances.
Thank you, Troy. Well, we just covered the foreign income exclusions and the related state issues. What I want to talk about right now is what goes on that W-2, box 1, that are taxable. As an organization, you need to look at your taxable allowance and non-taxable allowance and coordinate this list each year or as much as possible when needed with your program folks, those that are involved in the budgets for the grants and the contracts. You need to document what allowances are taxable and provide this information to your employees during the hiring process. Or if there's any changes, make sure that your employees in the field know. Finally, provide timely statements to your employees, detailing all their taxable income, non-taxable, and taxes withheld throughout the year. I've seen some organizations that provide a payroll rendering every payroll period, and it details exactly what went into the taxable compensation. Well, why are we talking about this right now? We're talking about it because there's going to be a surprise for those of you that don't realize that the moving expense, the relocation, even domestic relocation moving expenses are no longer tax-free to the employee. Another surprise, some of my tax clients come to me and ask is, what about TQSA, temporary quarters subsistence allowance? I didn't think that was taxable. Also, if you have your employee pay rent on their own and then you reimburse them, they may have to pay a year's in advance. Now, if they go over in the fourth quarter of the year and settle into Uganda and they end up paying $40,000 in rent for 2 years because that's what the landlord insisted on, you need to think about how, as an organization, you're going to handle that housing cost. And finally, home leave and R&R normally are taxable compensation put on the W-2. We have moving allowance again. Also need to mention bonus incentive compensation and any signing bonus that they may incur. Moving along, the impact of the Trump tax cuts on your organization as it relates to the expat. Well, I've gone through a number of written websites on the internet, and a lot of folks have differing opinions how it's going to affect an international organization. But you need to ask yourself, given the fact that you can no longer make moving expense tax-free, will you make your employee whole and add that cost to their W-2? Or are you going to have them absorb it? I don't know if it's going to make too much of an impact on your organization's budget, because you will most likely be able to pass that on to your contractor grant or your funder. But it's going to have a significant impact on your employees. Have you had a dialogue on this issue internally in your organization? And how will this change, the moving expense, the relocation expense, impact your present HR policies and your accounting policies and procedures? Will this impact how you change the future hiring of your international employees and or consultants? And how is this going to, again, how is this going to impact the compensation package? Expats still will be subject to dual taxation, as Troy mentioned. Now, unlike the Trump tax cuts made regarding U.S. corporations, where they are no longer, or they have an opportunity to no longer be subject to double taxation, expats will be subject to double taxation in many, many countries. They'll have to pay host country taxes and U.S. taxation if their compensation is over a certain amount. And in some countries, expats are going to have to pay into two Social Security systems because the country that they live in, for instance, Kenya, does not have a totalization agreement in place. So they have to pay Social Security into the Kenyan system and also into the U.S. One of the minor changes is a U.S. citizen will no longer be able to deduct foreign real property taxes. What's this? It's personal property tax on an automobile, computer, equipment, furniture, etc. They used to be able to take it on their U.S. returns, but that will no longer be the case unless they are a consultant and have self-employment reporting. Finally, how are you going to be able to minimize this impact? Well, the big change in this area to minimize it would be that the standard deduction in the new Trump tax cuts has changed drastically for the better. A married couple will now have $24,000 as a standard deduction. A single person will have $12,000. And many tax experts expect this will likely benefit the higher paid expat than the domestic taxpayers, since many expats do not itemize deduction. And the change in the standard deduction will most likely affect you in those organizations that have tax equalization, tax protection, or hybrid tax protection plans. It's going to cause you to go back and look at your plans and adjust them for the tax changes.
Mm-hmm. Thanks, Kate. We've now come to our second polling question. Has your organization begun addressing the taxability of relocation costs? Timely question. Your choices are displayed here, and while everyone is taking a minute or so to answer the question, and we will leave the poll open a little bit later this time. The second CPE word, everybody, this is your alert to write it down, is international. Again, the second CPE word today is international. INTERNATIONAL, international. Again, we won't be repeating those, so please write it down now so that you can enter it into the survey. Okay, we've got about, I think, 10 seconds or so left. Nope, the poll has ended. The poll has ended, and we're just waiting for results. And then, Kate, it will come back to you, but let's just wait for the results. Takes about 10 seconds or so, I believe. There you go.
Well, those are great results. Looks like a third of you folks out there say yes, that you started that conversation. Another third say no, but another 15% are saying no, but we're planning to. So that's great. Host country taxation. This will be the last topic I'm going to briefly touch on. And if you can talk about this issue, that would be great. Here we go. I think probably the first message I need to get across to everyone out there is you ought to assume that your employees will be taxed overseas by host country taxation, unless they meet certain exceptions. I know some of you say, well, we don't have that problem. You may have that problem. It may surface. Most of the countries that I have clients working in are very aggressive, and they're putting in place host country taxation. How do you get out of these host country taxation? Well, if you have a memorandum of understanding, your organization with that country to bypass their host country taxation. That's one way. A bilateral agreement between USAID or the U.S. government depends on the country, and I've seen a number of the bilateral agreements myself. They're all written in different language at different times of the year. Some of them go back to the 20s and the 30s, and some of them are recently written. And finally, if the bilateral agreement won't work and the memorandum of understanding won't work, a tax treaty might. But again, many countries that we have organizations working in don't have a tax treaty. Finally, what are the tax policies available in your organization? Do you have tax protection? Do you have tax equalization? Or are you thinking of a hybrid? And basically, the concept is that you're going to send somebody overseas, and you're not going to have them be punished tax-wise for going overseas and working, that you're going to make them whole in some way. What are the advantages and the disadvantages of each policy? You need to take a look at what your organization has, or maybe you just say, we're going to do this on an as-needed basis. We sent someone to Thailand last year and discovered they had to pay Thai taxes. We had to hire an in-house payroll person over in Thailand, and we said, we're going to pay the taxes, but we're going to reimburse the employee. Finally, has your leadership done a risk analysis regarding host country taxation in the countries where your organization works or plans to work? I would strongly suggest that you go through all those countries, prioritize where you have the biggest exposure, and sit down with your expat strategy team and see where you can handle this the best. Here's an example of expat taxation, allowance, and host country impact. So this is an example of a single person who's going overseas, and if they stayed in the United States, they would have more cash than if they left and went to a country where they had to pay host country taxes. And that's a pretty steep, that's like almost it's over 40% of their gross salary. Oh, and the housing is probably counted, and so's the post-diff. So what we're talking about is probably 15% of their total compensation. So you can see, and I'm using the new tax rates under the Trump tax cut. The difference is $13,000. So what would your organization say to this person when they came back to you and say, hey, I'm getting punished by going overseas. Can you help me out? Finally, the polling question, Jennifer.
Yes, so we've come to our final polling question. Does your organization have a host country taxation policy? If not, is your organization considering one? Your choices are noted here. The poll is open, so please feel free to go ahead and record your answer. And while you're doing that, I will give our final CPE word. Again, I know all of you are writing these down. The third CPE word is expatriate. Again, the final CPE word is expatriate. I'll spell it EXPATRIATE, expatriate. And we're going to give the poll a little more time so that everyone has adequate time to answer. Thank you for your feedback. For those who were having trouble, we're going to try to accommodate you. Okay, maybe 10 more seconds or so, and then we'll close out the poll and see what the results are. It'll be very interesting to see how many of you have this policy already. Okay, the poll is ended, and we'll get some results. Give it another 10 seconds or so. And thank you, WebEx, for running this portion of the WebEx. Okay, so Kate, you have your results here.
Thanks, Jennifer. Yes, we have about 20% have one. About 30% don't have one, but they're going to get one. And the rest are thinking about it. I urge you to at least get the conversation going. Thanks, Jennifer.
Thank you, Kate. We're now going to cover our last topic for the day, and that's wanted to touch on foreign bank account reporting. So when you send a person overseas, I often find that a lot of those employees are in the expats are in a high-level position and have signature authority over some of the local foreign accounts there. So one thing that you need to keep in mind is that there is a foreign bank account reporting form, otherwise known as the FBAR. It's Form 114, and it applies to U.S. citizens or resident aliens that have either a financial interest or a signature authority over a foreign account where the combined value of all of the foreign accounts exceeded $10,000 at any point during the year, which is not hard to do, especially when you're thinking about employees with signature authority over organizational accounts. There's a really good chance you're going to end up over that $10,000 threshold, and then they're going to have to file this form. So there's no tax or fee associated with filing the form, but there are penalties, and the penalties can be significant for not filing it. So it's important that you recognize that by sending a person overseas, that you've created an additional filing requirement that they have, and that you'll need to provide them with information in order to meet this requirement, and you should probably also inform them, at least basically, that this is out there and that they need to pay attention to it. The due date, it is a form that's filed separately from their tax return. It is electronically filed. It cannot be paper filed. You used to be able to paper file it, but you cannot anymore. Most tax software has the ability to file it, but people can also take care of it directly online at the BSA e-filing website, and I've got the link to that website here. If you've missed this filing requirement, either at the organizational level or at the employee level, there's a 6-year statute of limitations that applies. So if you've missed it for 10 years, all the IRS would want to catch up with that is 6 years worth of old filings. So you want to go back and think about whether you were going to do that. Again, there are penalties for late filing or not filing the form, but if you have reasonable cause, you can get those penalties abated or not even assessed to begin with. So when you e-file the form, when you e-file a late form, the IRS has in their system about 8 or 10 canned reasonable cause responses, and you can select one. And generally, they'll accept these signature authority only late FBARs when you check off a reasonable cause response without assessing a penalty, because the main focus of this form and the main intent for its requirement is to try to catch people who are missing out on foreign income reporting based on hiding money overseas. So the main target from an IRS perspective is trying to catch people who are hiding investment income overseas. And they have a hammer here with these penalties related to this FBAR form, but they do also have the signature authority requirement as well. So, you just need to be aware of it and file it and try to do it on time. The due date is April 15th, but there's an automatic 6 months extension to October 15th without having to file an extension. So if you haven't filed it yet for 2017, even though the regular due date is April, you don't have to file an extension. You automatically get 6 more months, so you're not late for 2017. So you can go ahead and take care of that now.
Okay, great. So we have received some questions from our participants, and before we wrap up today, I thought maybe we could answer a few of these. And one that kind of pops out at me, again, related to FBAR, Troy, who is responsible for completing the FBAR form, the employee or the employer? And what are considered some best practices, regarding this compliance issue?
Okay, good question. So the person who's responsible, so the organization has a filing requirement and the employee has a filing requirement. So for the organizational's FBAR, that will be, the organization itself. So it's probably somebody in finance would be the responsible person for making sure the organization's FBAR was filed. But the employee's FBAR ultimately is the responsibility of the employee to get it filed. So the organization can't file it on their behalf without the employee's signature on the e-file form. So they could have it prepared for them as a best practice, they could hire someone to prepare all the FBARs for their applicable employees, and then send them, a copy for their files along with the e-file authorization form for them to sign off on, and then they could kind of handle the process. So that would be a good way to approach it. I think if you're not going to do it for your employee, then you would at least have it in your system to provide the information before April, probably January, February timeframe, get all the information that's required, the bank name, address, account number, max value, get everything they need so they can take care of it on their own in a timely way.
Okay. Thanks, Troy. We've got another question here about host country taxation. Our organization is going to send 3 employees to Kenya. What host country taxation issues do you think we need to consider or take action on before we send our employees? Kate?
Okay, that's a great question. Well, first off, immediately I want to make sure that organization is registered to do business in Kenya. And obviously, most of you know, if you've worked in Kenya, that they do have host country taxes, and they are very aggressive. Troy and I were involved in a situation with an NGO, 6 months ago, where Kenyan authorities, tax folks, came right up to their office and demanded to do an audit on their payroll. And the reason Kenya is a little sensitive area right now is that the government changed their president. And because of it, new tax laws were put in place. So you may not even realize that you are subject to host country taxation because of a change in the government. The other thing you ought to consider would be to find host country legal advice, and also in Kenya they have chartered financial folks that they follow the UK system, the British system. And you ought to at least talk with some other NGOs in Kenya and find out how they manage this issue. Thanks.
Thanks, Kate. I have another question here, again, going back to moving relocation expenses. We sent an employee to Nigeria in 2016 and paid for her moving expenses. She will be leaving Nigeria at the end of this year, being 2018. Will her moving expenses be taxable to her?
Great question. And those of us in this expertise are waiting for the answer to this. The IRS has not come down with any ruling or letter ruling or any definitive opinion. So right now, yes, her move back to the United States would be taxable to her at this point.
Okay, great. Thank you for that. Got another question here. Troy, I think this one's good for you. There's some great scenarios being presented today. One of our new hires insists that he is not subject to state income tax withholding because he says his domicile is Washington State. How do I protect our organization from non-compliance issues now and in future years? When we hired him, he was living in Virginia and working for another organization. So I think I understand that question. Troy, do you want to see if you can answer that?
Yeah, I'll take that. So this is, not an uncommon issue that pops up where someone will be known to have been living in a taxable jurisdiction, and then when they move, try to claim a link to a non-taxing jurisdiction. So in this particular case, the person had not been working for the organization, for any period of time, so you don't really have a history with them. They were working for somebody else, so they're a new hire. So I think you're probably in a little bit more solid footing to just get a document from the person that for your files that shows the link to Washington State, whether it's their driver's license or utility bill or something else that would show a link to Washington State for your payroll records. And then I think you'll probably find just to, take their word for it, because you don't really have a history with that person, kind of working for yourselves and living in Virginia for 10 years. Everybody knows the guy and where they live and everything else. So this one's probably a little easier to deal with just because you don't have the history, and you can kind of take their word for it put something in the file and just say they're Washington State. Now, if you had a person that you did know that they had a house in Virginia and they've been living there for years and working for you, that's tougher. You probably want to reach out to an employment attorney and see what they say relative to just taking their word for it that they're, to stop Virginia withholding and code them as Washington State in the system. Again, if they can provide your driver's license, it shows that they, have taken some steps to change their domicile to Washington State. The ultimate determination of their state residency is on the employee. It's their tax position. So you really just need to make sure you have a reasonable position on your end to switch them from Virginia to Washington State by having something in the file.
That's good advice. Well, I think given our time, we have time for just one more question, and I've gotten a couple different versions of this one. I think this one's appropriate for you, Kate. Our organization discovered this year that one of our host country national employees is a dual citizen and has a U.S. passport. This was not disclosed when we hired him. How do I correct this for 2018, and what should I do in prior years?
Okay, well, thanks, Jennifer. This is a tough one, and I've actually been involved in something very similar. How to correct it for 18 is, I think you need to have a sit-down, or the organization needs to talk with this employee and tell them that they're going to issue them a W-2 for the earnings that they've earned wherever they're living, number one. Number two, and back up a minute, it may have to be a shadow W-2 where you recognize the salary, the compensation on a shadow payroll in the United States, and you withhold Social Security and Medicare. So that's the first one, particularly if the amount is under the foreign earned income exclusion. So we take care of 2018. Prior years, this can be a humongous process. You may have to go back 5 years, 4 years, 3 years, depending on what your payroll folks and finance folks and decide how to resolve this issue. But it would mean amending payroll returns, and all of us that have been involved in payroll over the years, we know that that's a headache. We have a lot of returns. We not only have the 941s, the IRS, but we have the state returns, and we have the unemployment returns, the federal unemployment, and the state unemployment returns. So, and this can be very expensive. Thank you.
Thanks, Kate. Well, I want to thank our presenters for this great overview today. And as we wrap up, I want to invite everyone to join us for the next webinar. It's going to be July 10th. Again, we'll be co-hosting with Humentum, and GRF's nonprofit tax experts are going to provide an update with clarifications from the IRS on the impact of the new tax law on nonprofit entities. So you'll want to register for that. Registration is going to be open very shortly, and you'll be able to find updates on our webinar here at this address, grfcpa.com/resources/events. And if you have any additional questions after today's program, please reach out to us. Our contact information appears here. Please remember, after you close out of the webinar, you're going to get a survey. Please plug in the CPE words there if you would like CPE credit. Again, we want to thank you for joining us today. Have a great day and go Caps.